Welcome to Invest with Neko B.
Please like and subscribe to our YouTube channel.
In this video, we will discuss about why diversification matters and how to balance risk.
Please share, like, and subscribe our channel.
So I want you to imagine it's January in the year 2000. You live in Houston, Texas, and you work for the 7th largest company in America.
Right, a total titan of industry.
Exactly. And every morning, you walk into this gleaming glass skyscraper, you grab your coffee, and you look up at the stock ticker right there in the lobby. I mean, the company you work for is an absolute juggernaut.
Oh, for sure. I mean, Fortune magazine had just named them America's most innovative company for, what, the 6th year in a row?
Yes, 6 years running. They're building broadband networks. They're revolutionizing energy trading. And here's the crucial part. You are heavily invested in them.
Naturally. You work there.
Right. You've been putting a massive chunk of every single paycheck straight into the company stock inside your 401k. And the stock is peaking at $90 a share.
Wow.
So on paper, you're looking at early retirement. You're a millionaire.
But, and this is where it gets incredibly grim, that was the absolute peak of the Enron bubble.
Yeah.
And what makes this specific scenario so completely devastating is just the time frame of the collapse. I mean, 14 months. That is all it took.
14 months. From $90 to nothing.
Basically nothing. From January 2000 to December 2001, the entire facade of Enron just shattered. The massive accounting fraud was exposed, the executives bailed out, and the company went completely bankrupt.
Just totally wiped out.
Yeah, that stock, which again was the absolute pride of Wall Street, it evaporated from $90 down to 10 cents.
10 cents. I mean, and this is why we're starting here, because the people who lost everything in that collapse, they were not reckless day traders, They weren't at a casino looking to get rich quick.
Yeah, not at all.
They were loyal, hardworking employees who genuinely believed in the place they worked. They saw the success with their own eyes in that building every day.
They trusted the leadership.
Exactly. So they concentrated their entire life savings into that single stock. And the consequence was this catastrophic double blow.
The worst case scenario.
20,000 people lost their jobs and their entire life savings on the exact same day. Imagine being 60 years old, thinking you're crossing the finish line into a really comfortable retirement.
Right.
And you wake up to realize your job is gone and your account balance is effectively zero.
It's the ultimate cautionary tale in modern finance. I mean,
Yeah.
Enron was not some fly-by-night startup, They were audited by Arthur Andersen, which was literally one of the top accounting firms in the world at the time.
It felt safe.
Incredibly safe. But the brutal reality of the market is that no single company, no matter how beloved, no matter how seemingly invincible, is safe enough to bet your entire financial future on.
And that brings us to why we're here today. Welcome to your custom-tailored deep dive. We're unpacking a pretty massive stack of sources today.
Yeah, we've got core financial fundamentals, historical market data, and Harry Markowitz's Nobel Prize-winning work on modern portfolio theory.
Right. And our mission with all this data is to show you why experienced investors constantly refer to diversification as the only true free lunch in finance.
The Holy Grail, really.
Exactly. We want to move you away from the anxiety of trying to pick the perfect stock and hand you the empowering relief of a stress-free, proven strategy. Because let's be real. Human psychology naturally pushes us away from diversification, doesn't it?
Oh, completely. We constantly look for patterns. We desperately want to find that one golden ticket.
Right. But, and I have to jump in here with some skepticism, because if I look back at the last, say, 10 or 15 years, the math of picking the right stock is incredibly compelling.
Sure, in hindsight.
Well, yeah, but say I invested $10,000 into Apple in January 2010, when the iPhone was really starting to take over the world. I actually did the math on this before we started.
Okay, let's hear it.
By 2024, that $10,000 turns into over $500,000.
Which is wild.
It's staggering. So looking at that, why on earth shouldn't a beginner just spend their time researching, find one truly great company with a massive moat, and just hold on for dear life?
Look, the Apple example is undeniable, obviously.
Yeah.
But you were dealing with a massive dose of survivorship bias there.
Survivorship bias.
Yeah, because we naturally remember the Apples, the Microsofts, the Amazon, because they dominate the headlines today, right? The illusion of concentration risk is that our brains conveniently erase the failures from our memory.
Oh, I see what you mean.
Take Nokia, for example. Do you remember Nokia in the early 2000s?
Oh my gosh, of course. I mean, practically every person on Earth had a Nokia phone in their pocket at one point.
Right.
The custom faceplates playing Snake under your desk.
Exactly. They had over 40% of the global market share for mobile phones. They were the undisputed king.
Right. They felt just as invincible as Apple does now.
And yet, if you bought Nokia instead of Apple during that 2010 timeframe, say you were betting that the established giant would figure out smartphones, well, your stock dropped from $8 down to $3, all while Apple was soaring.
Ouch.
Yeah, your $10,000 investment shrank to less than $4,000.
That's a massive hit.
Because when you concentrate your wealth in one stock, you are carrying 100% of what modern portfolio theory calls unsystematic risk.
Unsystematic risk. Let's break that down.
All right, so that is the specific risk tied to a single company's bad decisions, their product recalls, their scandals, or simply them just getting outcompeted.
Okay, so if picking one stock leaves you totally exposed to a company's implosion like Enron or Nokia, how does the math actually neutralize that threat? Like, as you add more stocks, how does the dynamic change?
Well, mathematically, your risk profile drops exponentially, not just linearly, but exponentially.
Yeah, how so?
Let's say you expand from owning one stock to owning 5 stocks equally. And let's say one company completely collapses, goes to zero, like Enron.
Right.
You lose 20% of your portfolio.
Which hurts.
It's a painful hit, certainly. But you still have 80% of your money completely intact and compounding. The other 4 companies can continue to grow and eventually offset that 20% loss.
Because they're completely separate entities.
Exactly. The statistical probability of 5 completely unrelated companies across different sectors going to absolute zero on the exact same day, it's vastly, vastly lower than a single company failing.
You know what I'm picturing right now?
Thanks that.
It's like the watertight compartments on a ship.
Ooh, I like that.
Right. If a ship is just one big hollow hull and it hits a rock and gets the whole thing fills with water and sinks, that's owning one stock.
Right.
But if the ship is divided into, say, 20 watertight compartments, a hole in one compartment only floods that specific section. The doors seal and the ship stays afloat.
That is a perfect illustration of the mechanics here.
Yeah.
And when you scale that up from 5 stocks to 20 stocks, you actually start building compartments against entire industries crashing.
All because industries move together.
Exactly.
Yeah.
Think back to 2020, during the initial COVID lockdowns. Do you remember what happened to oil?
Oil prices literally went negative for a brief moment.
Right, because global travel just completely stopped. So if your portfolio is heavily concentrated in energy stocks, you took an absolute beating.
Right. Your ship is taking on massive amounts of water.
But if you held 20 or 50 stocks across different sectors, your technology and remote work stocks likely skyrocketed as the world shifted online.
They cushion the blow for each other.
Exactly. And if we push this to its logical conclusion, owning hundreds of stocks, this is where we arrive at Harry Markovitz's breakthrough. The free lunch.
The Nobel Prize-winning concept.
Yes. Markowitz proved in the 1950s that as you add more and more uncorrelated stocks to a portfolio, your overall variance, meaning those wild, stomach-churning swings in your account balance, it shrinks dramatically.
So it smooths the ride.
Exactly. Once you hold 100 or more stocks across various geographies and sectors, that individual company risk, that unsystematic risk we talked about, it's essentially mathematically eliminated.
You just stop caring if a single CEO makes a terrible acquisition.
You don't even notice it. You've reduced your overall risk profile without sacrificing your expected long-term return. You are now only exposed to systematic risk.
Systematic risk, which is what exactly?
That is the broad, unavoidable risk of the overall economy. Just the fact that you are in the market at all.
Okay, but wait. That brings up the ultimate nightmare scenario, doesn't it?
How so?
Because if owning 500 stocks protects me from one company going under, what happens when the entire ocean drains at once?
Ah, like 2008.
Yes, exactly. In 2008, the global financial system essentially seized up. Every sector, every industry, everything seemed to be collapsing simultaneously.
It's terrifying.
So if I own 500 stocks and they all drop 40% at the same time, my watertight compartments didn't save me. The whole ship is going down.
And you've just isolated the exact limitation of holding only stocks.
Yeah.
To manage that broad economic hazard, that systematic risk, you have to move beyond just buying different companies.
You need a different asset class entirely.
Right. You have to understand the correlation matrix.
Okay, let's get into the correlation matrix. What is it?
Correlation is simply a mathematical measurement of how closely two distinct investments move in relation to one another.
Break down the scale of that measurement for us so we can really picture it.
Sure. So the scale runs from positive 1.0 to negative 1.0. A correlation of positive 1.0 means two assets move in perfect lockstep.
If one goes up 10%, the other goes up 10%.
Exactly. Now, a correlation of 1.0 means they move completely independently, like, say, the price of gold and the price of a used Honda Civic.
Right, completely unrelated.
And a correlation of negative 1.0 means they move in exact mirror opposite directions. One goes up, the exact other goes down.
So, applying this to stocks.
Well, if you build a portfolio out of 5 different semiconductor companies, they might have a correlation of positive 0.9. They are highly correlated.
Meaning if the tech sector crashes, they all crash together. You have the illusion of diversification, but not the reality.
Precisely.
You know, it's like trying to balance a diet by only eating different types of pizza.
Oh, I love this analogy.
Right. Like you can have a pepperoni pizza, a vegetarian pizza, and a deep dish pizza. That is a kind of variety, sure.
It's all delicious.
And pizza is fantastic. It provides a massive amount of calories and energy, which, in our analogy, is a higher return on investment.
Yes.
But if you eat nothing but variations of pizza every single day for 30 years, the volatility for your cardiovascular health is going to be extreme.
You are going to suffer some severe medical drawdowns.
Exactly. The human body requires entirely different nutritional profiles to remain stable over decades. You can't just survive on pizza.
And it is exactly the same with a portfolio. You have to introduce something fundamentally different to the plate. You need a salad.
And in the investing world, that salad is bonds.
Specifically, high-quality government and corporate bonds.
Right, because a bond is fundamentally different from a stock. With a stock, you own a piece of a company's future profits.
But with a bond, you are acting as the bank. You are loaning your money to the government or to a corporation, and they are legally obligated to pay you a fixed amount of interest over a set time, plus your original money back.
So, on its own, a salad isn't thrilling. It doesn't give you a massive sugar rush.
No, it's pretty boring, actually.
But when you combine the high-energy pizza with the stabilizing salad stocks and bonds, you get a smooth, sustainable meal.
And the historical data supports your dietary analogy perfectly here. Historically, broad stock market indexes and high-quality government bonds have a correlation ranging from negative 0.1 to negative 0.3.
So they are uncorrelated assets.
Yes. And the mechanism behind why this works is absolutely fascinating. It all comes down to human panic and institutional behavior.
Okay, explain that.
Well, when the economy is booming, stocks are surging, right? They're doing the heavy lifting of growing your wealth. And the bonds, they just sit there quietly paying interest.
Just being a salad. But when the panic hits...
Right. When a recession hits and stock prices violently crash, institutional money managers, billionaires, everyday investors, they panic.
They want out.
They want safety immediately.
Sure.
So they sell their risky stocks and they flood their money into the safest asset on the planet, U.S. Treasury bonds. They just want the government's guarantee that their money will be returned.
So by acting as a safe harbor for all that terrified institutional money, the massive surge in demand actually allows sellers to charge more for those bonds.
Exactly. The bond actually gains value at the precise moment your stocks are bleeding. The price of the bond gets bid up by the panic.
That is incredible. So right as your stock portfolio is plummeting, your bond portfolio is physically rising in value, acting as a counterweight.
It cushions the fall.
Okay, let's look at the hard evidence from the sources on this. Because we know the theory sounds comforting, but I really want to see the concrete numbers.
Let's do it.
When the financial world is literally on fire, how much does this pizza and salad combination actually protect a typical investor?
So the classic benchmark we use to measure this is the 60-40 portfolio.
Which means 60% of your wealth is invested in a broadly diversified basket of global stocks.
And 40% is held in a diversified basket of bonds. Correct.
Yeah.
And this specific allocation model has survived every major market crash, every world war, and every economic depression since 1928.
Wow, since 1928.
Yeah. Let's examine the 2008 financial crisis. We measure the damage using a metric called maximum drawdown.
And just so we are totally clear for everyone listening, a maximum drawdown is the measurement from the absolute highest peak your account reaches down to its lowest valley before it eventually recovers.
Right. It is the maximum amount of pain you feel on paper.
Okay, so 2008.
During the depths of the 2008 crisis, an investor holding a portfolio of 100% stocks suffered a terrifying 50% maximum drawdown.
Half of their net worth.
Half of their net worth, accumulated over decades, just vanished into thin air over a matter of months.
Which is absolutely stomach-churning. I mean, that triggers every primal fear response in the human brain. You feel like your survival is threatened.
Absolutely. But an investor holding the diversified 60/40 portfolio during that exact same crisis,
What was their drawdown?
their portfolio experienced a maximum drawdown of only about 25%.
Only 25%? I mean, that is a staggering difference.
It's massive.
A 25% drop still hurts, obviously, but it is a completely different universe of financial pain compared to seeing half your life's work disappear.
And we saw the exact same mechanism deployed during the 2020 COVID crash.
Oh, right, because that was incredibly sudden.
The stock market plummeted 34% in just 33 days. It was one of the fastest, most violent market crashes in recorded history.
And the 60/40?
The 60/40 portfolio fell only 13%.
Wow, just 13%.
Yeah. The bonds completely absorbed the shock of the equity collapse.
You know, this is why the sources emphasize a tone of empowerment here rather than restriction.
What do you mean?
Well, a lot of beginners look at bonds and they see the lower average returns compared to stocks, and they think, this is holding me back. I'm leaving money on the table.
Right. They see it as a speed limit.
Exactly. But diversification is not a speed limit. It is a shock absorber for your life. If you are 55 years old, hoping to retire at 65, a 50% drop in your life savings is a catastrophic event.
It makes you feel like you have to work another 10 years.
Right. You might panic, sell everything at the absolute bottom just to stop the bleeding, and permanently ruin your retirement.
And if you sell at the bottom, you turn a temporary paper loss into a permanent, locked-in loss. The bonds give you the psychological fortitude to simply log out of your account, grit your teeth, and ride it out.
Diversification manages your behavior.
Exactly. Ensuring you are still in the market when the inevitable recovery begins.
Okay, so if the 60/40 split, or variations of it, like 80/20 or 70/30, depending on how far you are from retirement, if that is the holy grail of stress-free investing, how does a normal person actually build this today?
It's easier than you might think.
Because I don't want to hire a wealth manager in a fancy suit who takes a massive cut. And I certainly don't have the time to go out and manually purchase 4,000 individual stocks and 10,000 individual municipal and government bonds.
Well, 30 years ago, achieving that level of diversification was incredibly difficult and expensive for an individual. But today, the modern solution makes it effortless through something called an ETF, or an exchange-traded fund.
Okay, an ETF.
You can think of an ETF as a massive pre-packaged basket of investments. Instead of buying a single share of Apple, you buy a single share of an ETF, and you instantly own microscopic fractions of thousands of different companies all at once.
And you just buy it like a normal stock.
Exactly. The ETF trades on the stock market just like a regular stock, allowing you to buy global diversification with a single click.
And the sources outline a literal blueprint for this, right? One that is famous in the financial independence community.
Yes, it is called the three-fund portfolio.
It is incredibly elegant in its simplicity. We can actually break down the mechanics of it using real ticker symbols from Vanguard, though, you can easily find the exact same equivalents at Fidelity or Charles Schwab.
Right. It's not about the specific brand. It's about the structure.
Exactly. So let's walk through the three pillars.
The first pillar is your domestic growth engine. The ticker symbol is VTI. This is the Vanguard Total Stock Market ETF.
And how much of the portfolio is this?
In a standard setup, this might make up roughly 70% of a younger investor's portfolio, or maybe 60% for someone older.
Okay.
When you buy one share of VTI, you are buying a tiny fractional piece of virtually every publicly traded company in the United States, over 4,000 of them.
Wow.
You own the massive tech giants, the regional banks, the local energy providers, the healthcare conglomerates. When the U.S. economy grows, when thousands of companies innovate and sell products, this fund grows.
Which means every time someone buys a coffee, fills up their gas tank, or upgrades their software, a fraction of a penny is ultimately flowing back to your portfolio.
That's the beauty of it.
But you also need geographic diversification, right? You don't want to bet the entire success of your retirement solely on the United States economy.
Right, because what if the U.S. has a lost decade?
Exactly. So pillar number 2 is VXUS, the Vanguard Total International Stock ETF.
And this typically makes up about 20% of the portfolio.
Yeah. And this one fund holds over 6,000 companies located outside the U.S. borders. You are buying into the established economies of Europe and Japan, the mining operations of Australia, and all the rapidly growing emerging markets.
So if the U.S. market goes through a stagnant decade, which it definitely has done in the past, your international stocks are there to carry the weight.
Exactly. And finally, the shock absorber, the salad.
Right. Pillar number 3 is BND, the Vanguard Total Bond Market ETF.
And this is the last 10%.
Yes, you allocate your final 10% here, and you gradually increase that percentage as you approach your retirement year. BND holds over 10,000 different U.S. Treasury bonds, high-grade corporate bonds, and mortgage-backed securities.
So it pays you a steady stream of interest every month.
And more importantly, it provides that negative correlation when the stock market panics.
When you zoom out and look at those 3 ticker symbols together, VTI, VXUS, BND, you realize you are holding over 20,000 individual global assets.
Staggering.
You effectively own a slice of the collective labor and innovation of the entire planet. But what makes this strategy the undisputed champion for retail investors isn't just the sheer scale, it is the cost.
Well, the cost is the best part. The financial industry traditionally makes its money by charging really high fees to manage your wealth.
Right, they take a percentage of everything.
But the expense ratio on these 3 index ETFs is almost unbelievably low.
Yeah.
An expense ratio is simply the percentage of your total investment that the fund company takes each year to cover their operating costs.
Okay, so what is it for this portfolio?
For the 3-fund portfolio, the blended expense ratio averages around 0.03%.
0.03%. Let's translate that percentage into actual dollars, because percentages can kind of hide the true impact on your wealth.
Sure. If you invest $10,000 into this 3-fund portfolio, Vanguard is charging you roughly $3 a year to maintain it.
$3.
$3.
For continuous, automated exposure to the entire global economy. I mean, contrast that with an actively managed mutual fund where a highly paid team of analysts in New York tries to guess which stocks will beat the market.
Oh, yeah, they might charge you an expense ratio of 1% or even 1.5%.
Which translates to $100 to $150 a year on that same $10,000 investment.
And the crushing reality for those expensive funds is that the data proves they rarely work.
Right.
Over a 20-year timeline, this boring $3 a year index portfolio mathematically outperforms the vast majority of those highly paid, actively managed funds.
They just can't beat the market consistently.
No, the active managers cannot consistently overcome the drag of their own high fees.
It is the ultimate set it and forget it strategy. It lets you step completely away from the anxiety of the casino. You lock your wealth into a diversified vault, and you just get on with the actual business of enjoying your life.
Exactly.
So when you look at the entire journey of this deep dive, the narrative arc is incredibly clear. We started with the tragedy of Enron, the brutal human cost of putting all your faith and all your resources into a single company, ignoring the reality of unsystematic risk.
Right. And then we explored the mathematical solution, discovering how increasing your holdings essentially eliminates that individual company risk without destroying your returns.
We introduced the critical function of correlation, learning why holding entirely different assets, like the pizza and the salad of stocks and bonds, is necessary to survive systematic market panics.
We looked at the historical hard data showing how the 60-40 shock absorber protected wealth during the terrors of 2008 and 2020.
And finally, we unpacked the blueprint of the 3-fund portfolio, giving you the practical tools to build a globally diversified, incredibly low-cost financial engine.
The sources make an absolutely airtight case that your financial capital requires broad diversification to survive and thrive.
They really do.
But, before we wrap up, this entire framework actually raises a pretty provocative question about the rest of your life.
Oh, where are we going with this?
Well, we've proven that betting your financial capital on one stock is extremely dangerous. But what about your human capital?
Oh, wow. That is a fascinating pivot because your time and your labor are an asset class too.
Exactly. If you work in a highly specialized sector, say commercial real estate or venture-backed tech startups, your primary source of income, your paycheck, is 100% correlated to that specific industry.
Right.
If that sector experiences a severe downturn, your income is instantly at risk. So the lingering question to mull over today is this. Are you applying the mechanics of diversification to your personal skills, your network, and your income streams?
Or are you inadvertently making the Enron mistake with your career?
Exactly. Leaving your human capital entirely exposed to unsystematic risk.
That is a brilliant challenge to leave off on. If you've taken the steps to ensure your financial portfolio is diversified, you really owe it to yourself to make sure your life's portfolio is structurally sound, too. Thank you for joining us on this deep dive. We hope unpacking these mechanics has replaced the anxiety of investing with true, actionable empowerment, and that you are ready to build a resilient, stress-free foundation for your future. Until next time.
That's a wrap for today. See you tomorrow with another lesson.
Don't forget to like and subscribe. See you then.
The information provided on this podcast is for educational and informational purposes only and should not be considered financial, investment, or legal advice. I am not a financial advisor, and the strategies or assets discussed may not be suitable for your personal financial situation. Investing involves risk, including the loss of principal. You should always consult with a licensed professional before making any financial decisions.